Now, before we get into segment 2, we just want to reiterate, please like, share, subscribe. Your support is appreciated. And so we ended the first segment on this slide, and I want to start on it again because I think the peak is interesting. And it's one of the things that we talked about in the EIA show, the economy show previously, was the reopening trade, which we saw peak in late April. And that's why when we look at, what has reopening been in the U.S., one of the things that we said in mid-March was that March was going to be gangbusters, that we were going to see this massive shift higher because that was when that pent-up demand was going to come to market. When we look at March into April, that was when we expected to see this big surge in activity. And when we look at just what the U.S. consumer has done, it happened in that exact time period. And now we're starting to see a little bit of that slowdown because things are starting to get back to normal, and you've started to absorb some of that pent-up demand that was sitting behind. And that's why when we look at, okay, well, now prices are going up, you have inflationary targets shifting higher, and this additional pressure. So I think you're starting to see that weigh down some of that future activity. Not to say we're coming back to these lows, because we're not, but we will start to get back to some of the levels that I think we saw in late, let's say late summer. We'll start to get some of that seasonality push as we have people going back out. But when we look at some of that initial movements, when we look at furniture, home appliances, a lot of that is starting to ebb, and we're starting to see some of that slowdown as those home sales take a breather. We obviously they're seasonal, so we'll have to look for some of that seasonality, but it's just not coming in at the moment, and that's why it's going to be important when we think about, well, where does the next cycle of buying come in? How is this going to look over time? Which is when we start to look at the U.S.-China Phase 1 trade, tracker on the trade deal. So we just had the first meeting of the trade czars, and they've agreed that it's important to keep talking about how this is going to look. And again, a lot of talking continues to happen, while we still continue to track below what was agreed upon. And this is as going back to April. And there's just not that consumption that we would expect. And again, it's just following the same trail of sadness or disaster in terms of just we're never going to get back to that level. And the reason why is, for a lot of reasons, but one of the big ones remains local Chinese demand. Local Chinese demand is just not there. And it's something that we're going to talk about more in segment 5. But we continue to see the Chinese consumer underperform, and then the U.S. consumer outperform. So we're seeing those imports, and we're just not seeing the respective exports. Obviously, food and grains have closed some of that gap, but on the goods side, when we look at those U.S. exports, they continue to miss by a wide margin, and there's little in the way of getting back. Because when we look at 2020, you could say, well, there was COVID that hindered it. Well, China's been reopened now for a long time, and they're still not coming even remotely close to where they should be in this regard. That's why when we look at China imports by product type, it's important, because when we look at grains, agriculture is obviously getting very close because they need that grain side. But the biggest issue is going to remain manufactured goods, which are continuing to miss. We're seeing a bigger shift in terms of where things are going away from. Energy is another one, is just a big swing and a miss, because when you look at China is playing the game. They're not buying as much from Angola. They're not buying as much from the Congo. So there's just less demand for energy, because if you're not going to buy from Africa, which on a freight rate level, on a cost level, on a quality of crude level, it's going to be difficult to buy from the U.S. Now, they have started to buy more ethane, more ethylene for their petchems, but they've decreased the amount of condensate. They're not buying refined products because they're making their own. They're actually becoming a much bigger exporter of that. And again, that's creating some of that friction. So the manufactured and energy goods just won't be there in terms of target. Then when we look at U.S. exports, going into the region, again, it's showing the same type of problem that just isn't going to go away. But when we look at U.S. exports of grains, corn just flies off the shelf. And now that we did have some cancellations, some movements, one of the things that we've been very bullish grains for a very long time, we had recently gotten out of some of those positions, and now we're just looking at it and saying, look, now there's going to be this friction because U.S. grains have progressed nicely. So when you think about, okay, well, it's progressed in a positive light. So now it's like, what is, now it's tracking weather, precipitation, where do things sit in general? And Latin America still remains a big struggle. Asia continues to be a struggle, especially with just droughts in both locations where the U.S. has been fairly strong. So it's going to be a matter of how much does the U.S. offset some of the reductions in other regions, which would be a net positive for U.S. exports. But again, these are things to watch. And in the meantime, there's going to be just a lot of noise and just general grain pricing because of this push back and forth, which is one of the reasons why we've looked further down the curve in terms of fertilizers, because they're going to want to try to increase yield to capture the grain prices. Best way to do that is just more volume. So that's why we've looked to, okay, well, now that precipitation has gotten a bit better, we're seeing some of these crops emerge well. Well, let's make sure that we get them there. That's more fertilizers, making sure that they're doing the right thing to really incentivize some of this growth, which is when we start looking at, okay, well, when we talk about commodities, we have to speak about inflation. And one of the things for those that have been watching us from the beginning, which was over a year ago now, we've been very adamant about inflation. We've been saying, look, we're seeing these prices. And then our detractors or people that were saying that we don't get it, they're like, oh, you're just talking cost. And it's like, okay, but how is the price a company charges a consumer? How do they come up with that price? It's not just thin air, dart on a board. It's what is their cost? Well, if their costs are going up, it will inherently be a problem because that means that their prices are going to go up. So for some reason, the market continued to ignore some of these numbers, which is why the inflation surprise has surprised to the upside, because the expectations were way too low based on the whole supply chain that we're seeing, which is why we keep talking about from the tip of the spear, which is PPI and input prices in places like China, South Korea, Japan, Germany, key areas that we import from, India, because that is going to show, well, okay, now that we looked at that, what are freight rates doing? Okay, now that we looked at freight rates, what are import prices look like? Now let's look at what do trucking prices look like? What does labor look like? As you can see how it kind of feeds down that line. And that's why we keep seeing some of this additional pressure coming through, which is going to maintain some of that elevated levels, which is when we turn to cyclical versus acyclical movements on that PC inflation level. And one of the things that's interesting is that acyclical, because we're seeing some of those movements come back. And the U.S. has exported inflation for 20, 25 years. We've seen technology continuously move down, logic chips, in terms of tech, storage of data, all of that capacity has constantly gotten cheaper. And one of the things that we asked last year is, well, what happens when it stops getting cheaper? And it doesn't have to explode up in price, but when you're dealing with pennies on the dollar, any kind of movement is going to reverberate through the system. Now, factor in supply chain shortages, raw material shortages, and you're starting to get a lot of this shift in terms of that inflation contribution, which is the core PCE, which the Fed says is a better way of kind of looking at this, where cyclical is starting to come down a bit. We're starting to see some of that, not so much come down all the way, but kind of flatline to normalize, where now we're getting some of that acyclical push that has really started to come back up. And when you look at the exporting of inflation to importing inflation, I think now we're at the peak of importing that inflation overall as those input costs continue to go up. And what are companies trying to do? Well, they're gross fixed capital formation. So they're investing more in that ICT equipment and software. They're seeing more investment across technology because they can't, when they look at labor costs and labor costs going up and having to pay people more to come back, it becomes very difficult to pass down that additional cost, which is why they're looking for technology to replace some of this labor. which is where you're getting this big disconnect. And that's something that I think is going to play out in this month's jobs numbers, which come out on the tomorrow and the 4th. So we're going to talk about it on Friday, mixed in with the Frac Spread show. And then when we look at, what has happened overall, the Atlanta Fed core CPI inflation, sticky versus flex. So the core, or the stickiness of that CPI, still remains above 2%. It's at that 2.3%. But the flexible CPI is up at 8.2%. Now the problem is we're seeing some of that core stickiness move up. And it's the reason why we say that, as we talked about it last week, rents are going higher, and rents going up is going to be some of that stickiness. We have more shutdowns of car production in Latin America. We're seeing some of this movement that is going to go from flexible into sticky. And I think you're going to see kind of go from that 2.3% much closer to 3.5% as you see some of that coming down and really sticking within the flow. And a lot of that can be tied to the Fed. So now the Fed is now a bigger player in the U.S. Treasury market than foreigners, which I think is going to become a much bigger problem when you think about, okay, well, when does tapering happen? How do you taper if you're the biggest buyer? Because in order to replace you, you're going to have to incentivize people to replace you, which is higher interest rates. So when you think about Fed tapering, can they taper without raising rates? And the short answer is them tapering will inherently drive up rates. So then when they do raise rates, it'll already be fully priced into the market. And that's why one of the things that we talk about when we look at the reserve repo, which we'll discuss later on, it's so important because that's where the issues arise, and we're going to see more of those conversations come forward. But one of the interesting things I think this talks about is how consumption has changed. And while people feel better about the situation of COVID, you can still see people are a little hesitant on going indoors, which is going to be, and I think is showing up in an interesting way in a lot of outdoor stuff. People are looking to get an increase their adoption of smoking, meats, barbecues, because I think you're going to see more people do stuff outdoors. Again, some of that normalcy coming back, not quite getting back to where we were, but again, these are things that are going to be net positives for just consumption patterns and just movement within the U.S. But when we turn to the U.S. ISM Manufacturing, and this is, I think, some of the key sides, because we had some misses across the board, and we had obviously the headline number beat, but some of the other things have gotten a little bit worse. And that's why we like to talk about, okay, well, what got worse? Here's the headline number, but what happened with new orders, with production? So when we look at where things shook out, okay, well, let's look at ISM Manufacturing. So where did ISM Manufacturing go overall? And for some reason, I actually forgot to write in the number. So I will just get the underlying just so we can talk about it and keep everything same. So ISM Manufacturing came in at 61.2. Expectations were for 61. Clearly, very good number, but what is the driver? So when we look at the ISM Manufacturing numbers, we look at, okay, well, production, positives, new orders, positives, but then we look at supplier deliveries, which continued to get worse. So when we look at ISM respondents, the continued global supply chain tightness and raw material shortages from the Gulf make it less likely that any business can recover this year. Demand is strong, but what good is that if you cannot get the materials needed to produce your finished goods? So that's that disconnect between pricing, just taking whatever the supply chain will give you, as you have no choice because you don't have inventory that you can live off of, or you've already lived off the inventory you had available, and now you're beholden to what is in the supply chain. So when we look at suppliers' deliveries, rose to 78.8 versus 75, which is the highest since 1974. Customer inventories fell again to 28 versus 28.4, lowest on record. Backlog of orders rose to 70.6 versus 68.2, highest on record. Prices paid fell a little bit to 88 versus 89.6. So you're still seeing prices paid elevated, coming back a little bit as you saw some of that raw material normalize, but the rest of the backlog, the consumer inventories. So customer inventories will eventually be up net positive because you're going to have to restock. So that's going to be a positive for GDP. That's going to be a positive momentum for manufacturing, but you have to get to the point where you have something to sell for people to buy. And that's where we're getting some of that stickiness, which is why when people talk about, oh, well, the market's going to reject price increases, well, it's going to be difficult at the current inventory levels. I agree if their inventories were a bit more normalized, you'd see some of that pushback, but that's why I think you're going to see inflation last longer than theoretically it should, because you do have these shortages, and that's going to be something to consider when we're looking at the inflation into stagflation cycle. So then when we look at ISM production, so production came off hard. Again, that comes down to just the inability of doing anything. So the slight beat from May ISM Manufacturing at 61.2 versus 60.9 estimate and 60.7 in the prior month. But new orders were stronger at 67 versus 64.3. And prices paid cooled a bit, but production down along with inventories. So people just can't produce because they don't have the capacity. So you saw that big drop from to 58.5. And what does that mean? Well, employment. So employment also had a big move down in May, which again is speaks to, well, what does non-farm payroll going to look like? What are payrolls going to do? Because you're having people that are just working less hours or just being furloughed again because they have to wait for the supply chain to catch up to have those workers back. So now 50.9, it's still expansionary, but at a much tighter level. And it's within a margin of error in terms of, well, what does that mean going forward? Because are we going to see that big spike up, or are we going to kind of stay within this weird kind of anomaly? And I think that we're going to stay fairly depressed, just given not only just anecdotal stories, but also what the data is telling us. And I think the non-farm payroll is going to be important to see where are we on that cycle. This is just looking at delivery times for materials, which are now at 90 days, up almost 20 days in 3 months. Then the increase in ISM new orders just below 17-year high and longest delivery time since 1974 indicate manufacturers continue to struggle with supply shortages, shipping delays, and difficulty finding skilled labor. ISM May prices paid eased from highest levels since mid-2008. Again, just looking at those problems that we see. And when you just look at the sheer size, we've never had this outsized move at this level unless you go back into the 70s. And it's just going to take time to rejuvenate that, especially because we do have reopenings. We do have demand going up, which on a cyclical level, when you just think about some of these movements, it's going to be difficult to kind of normalize and catch up with itself. So then when we look at this matched overall, so supplier deliveries continue to higher, ISM prices paid came back a bit, coming down with the commodity spot price index, because the spot price index is off the highs, still elevated. But you can see that even though it came down pretty hard, prices paid didn't come down at the same level. And that's what we've been talking about, that prices paid are going to remain sticky because there's other things that are married into that prices paid. That's labor, that's how many employees you have, how many hours they're working, overtime you're paying. A lot of these things start coming in. So even though commodity is a very large input to that, it's still not the only input. So while normalizing or commodity prices not going up to the same degree is good, it's not going to turn into all of a sudden prices paid collapsing, because prices paid have also gone well ahead of prices received. So you're still going to also see some of that continuing to push down in order to see movements through the system. So then when we look at the depleted customer inventories, as for future production, the highest reading on record for order backlogs and lowest for customer inventories point to factories playing catch up for an extended period, which is that positive. Though significant inventory build is unlikely over the short term as demand soaks up supply, the transition from stock depletion to accumulation will again be that net positive for some of that GDP. past cycles and the current extreme for customer inventories is shown over here, which is where we're looking at some of these big drops. So that's why we think there's going to be some of that normalcy over time. But when you look at, coming out of 09, you saw some of that, bounce back and forth because they will take whatever the market's going to give them to a point. And then once they get to a level of at least some comfort in inventories, they'll start to push back and they'll reject some of those price increases, which is why it'll take several quarters or over a year to really see some of this, getting back to normal, just because they're going to try to work that price so that they're not, just taking whatever price is there and seeing their prices drive ever higher. And this is just looking at U.S. retail inventories, which they've obviously recovered from 2020, but now they're coming down again. And that's, again, the customer or the retail consumer has come out. Again, that reopening trade has been there. People, they wanted stuff, they went out and got it, and now you're starting to see that reflect in some of these inventory levels on the retail side, and then the at the end, the consumer, where the pushback and that friction is going to remain in terms of where do we go from here? And that's why we keep talking about that stagnation after we see that last push of inflation. And this is just looking at it from the perspective of supplier deliveries, where you can see we had that nice little spike in the beginning of in the 1970s. Now, do we get to this level? It's possible, given the issues on freight that has yet to go away, the problems with additional strikes and just things or problems reverberating through the supply chain. But you can see that once you get up there, it normalizes a bit, fairly quickly. My point is that due to the raw material, the issues just across that supply chain are so vast, and we're now so interconnected in terms of just the global economy, where we came into this at time deliveries, asset light inventories. So the rebuild, or at least these delivery times are going to take longer to normalize, which is why it's going to exist longer in the system. Looking at, again, that customer inventory versus backlog. So eventually you'll start to see this kind of normalize, speaking back to 2009, 2010, where we saw something in terms of that restocking. We're going to see something similar in terms of just because if you look the backlogs versus the inventories, and then you started to see a bit of this shift. Now those happen together. Now we're going to, because obviously recession, you had the backlogs drop, where here's a little bit of the opposite, where you're going to have to see some of that normalization over time. And then I think the more important side is going to remain those output prices, where output prices are now back at those highs, which again speak to that movement where the hope was you were going to get some stabilization up at that top after you had that little pullback. Instead, we just exploded higher again. And there's very little to say that we're not going to continue to see that movement higher, especially when you look at what, not only just the Fed, but all central banks are doing, as we talked in the first segment, when we looked at inflation and those inflationary pressures that are continuing to remain in the system and have yet to work their way through, which is why we aren't done yet with these movements in prices to the consumer.